Warren Buffett is often presented as a formula. Read financial statements, be patient, invest for the long term. But that narrative hides something essential. Buffett didn't win on strategy alone. He won because of context. And if you try to follow his exact steps today, in 2026, you're not really repeating Buffett. You're just copying the surface of a much deeper story. To understand that, you have to look at the full arc of his journey. The strengths, the right decisions, the real mistakes, and the limits, without the mythology. Warren Buffett was born in 1930 in Omaha, Nebraska, in the middle of the Great Depression. His father, Howard Buffett, was a stockbroker and later became a congressman. That didn't make Warren rich. But it did something that may have mattered even more. It made the financial markets feel normal inside his home. While most kids saw the stock market as something distant, Buffett grew up hearing about stock prices, risk, interest rates, and economic cycles. At 11, he bought his first stock. At 13, he was already filing a tax return. And by 15, he had built up meaningful capital through small businesses. That early start isn't glamour. It's a cumulative advantage. While most kids saw the stock market as something distant, Buffett grew up hearing about stock prices, risk, interest rates, and economic cycles. At the University of Nebraska and later at Columbia, he studied under Benjamin Graham, the father of value investing. Graham taught a simple but rigorous principle. Invest with a margin of safety, protect your capital, and ignore the market's mood. Buffett took that idea to the extreme. In the 1950s, he launched private investment partnerships and began exploiting obvious inefficiencies in the American market at the time. Companies trading below cash value, stocks ignored by analysts, and businesses the market simply didn't understand. The result? Returns that consistently beat the market. One detail that rarely gets mentioned is this. Those opportunities existed because the market was structurally less efficient. There was no digital data, no large-scale quantitative analysis, and no globally competitive fund industry the way we know it today. Buffett wasn't just skilled. He was operating in an environment that strongly favored the patient, analytical investor. In the 1960s, Buffett took control of a declining textile company called Berkshire Hathaway. This was not a brilliant move. By Buffett's own admission, it was a mistake. He held onto the business out of emotional attachment and an unwillingness to admit a bad investment, something he later described as a classic example of poor capital allocation. But that mistake led to an unexpected outcome. Berkshire stopped being just an operating business and became a permanent investment vehicle, with no redemption pressure and no short-term mindset. The acquisition of insurance companies like GEICO gave Buffett something decisive: float. Float, money collected before it has to be paid out in claims, allowed Buffett to invest low-cost capital for decades. That model changed everything. From that point on, Buffett began buying entire businesses, not just stocks: See's Candies, Coca-Cola, American Express. This is where the Buffett most people know was born, but also the version that is hardest to replicate. Buffett's greatest evolution wasn't financial, it was intellectual. Influenced by Charlie Munger, he moved away from the obsession with cheap companies and began looking for great companies at fair prices. That shift becomes especially clear in Berkshire Hathaway's annual shareholder letters, now treated as classic texts on capital allocation. A few defining moments. In 1987, after the crash, he reaffirmed that he would not sell great businesses out of fear. In 1999, he warned about the internet bubble, even while being mocked for it. In 2008, in the middle of financial panic, he wrote, "Buy American, I am." Those letters reveal something central. Buffett does not predict the market. He manages behavior, his own and his shareholders. He accepts years of underperformance, public criticism, and staying out of profitable trends when he doesn't understand or trust them. That discipline is rare, but it also depends on something very specific: unlimited time and patient capital. Buffett is not infallible, and he has always insisted on that. Some of his acknowledged mistakes include keeping Berkshire's textile business for too long, missing early opportunities in companies like Google, Amazon, and Microsoft, and underestimating technological change at certain moments. He has said that his biggest mistakes were not the losses everyone could see, but the opportunities he failed to take. There is another point that gets even less attention. As Buffett's capital base grew, his universe of opportunities shrank. Today, Buffett can't invest in small companies the way he once could. He is simply too large. In other words, his own success reduced his future ability to repeat his best early results. Warren Buffett built a fortune of more than $100 billion by combining factors that rarely exist together. He started extremely early, had practical financial education from childhood, invested in much less efficient markets, built a unique capital structure, and maintained emotional discipline for more than 7 decades. That is why so many people fail when they try to copy Buffett. They copy the quotes, they copy the patience, they copy the long-term mindset. But they cannot copy the historical timing, the type of opportunity, or the competitive environment in which he came up. It is not 1950 anymore. That market no longer exists, and very few people today will have uninterrupted decades to make only a few mistakes and let capital quietly compound. Buffett is not a script to be followed step by step. He is a case study, and maybe the biggest lesson is not in what he bought, but in what he avoided, what he waited for, and how deeply he respected the limits of his own context. It's worth remembering one of his most famous, and perhaps most misunderstood, quotes. "The stock market is designed to transfer money from the active to the patient. That is not an invitation to blind passivity. It is a warning about behavior, expectations, and time." In your opinion, what is the most relevant lesson from Warren Buffett's story for investors today? And what part of it simply can't be applied anymore? Leave your thoughts in the comments. And to find out how the richest man in history lived, just click the card above.